The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Hello and welcome. My name is Andrew Paolello. I'm the Director of Member Strategies and Solutions here at the bank, and thank you all for joining us today. So today the plan will be to cover three main areas. We're going to look at what's happening with interest rates in the mortgage markets and the economy through a lens that is mostly relevant to our members. We'll take a look at some key takeaways from first quarter 2021 call reports, and then we'll go through some particular strategies that members can be looking to deploy to shore up the balance sheet. So before we jump in, what is not on the agenda today, which seems to qualify for financial market news these days, are some of the things we see here. So unfortunately or fortunately, no GameStop, cryptocurrency, or NFT talk here. So sorry to disappoint. So if along the way there are any questions, please feel free to submit in the chat box, and we'll address them as they come or towards the end. So let's jump right in. So first, what's happening with the markets and the economy. Looking at what is going on with short-term interest rates. And full disclosure, we update this table every quarter, and the header there that you see talking about the trend of rates are low, but they keep going lower. We haven't had to change that the last three times out because it continues to be true. So the front end of the yield curve from treasuries 1 year and in, but also to the overnight indices as well as the term LIBOR rates continue to grind lower and lower. So the short-term interest rates are often referred to as the plumbing of the financial system. So when you think about what's going on with SOFR repo rates as well as Fed fund rates, effective Fed funds, it does bear some watching because of potential policy tweaks that could come into play. So as you can see here, the solid lines of Fed funds and SOFR year to date are converging towards zero, so for more than Fed funds. And in the case of other comparable instruments like T-bills, they actually have gone negative in some cases. So, simply put, the Fed probably doesn't want to see negative rates from an optics standpoint. So most of our members don't participate in these markets. Our depositories utilize IOER at 10 basis points. So why should we care about what's happening in these other markets? But it's because of the interconnectedness and the potential policy tweaks, as we mentioned. So there's two things that are on the horizon that could happen. The first one would be the Fed bumping the IOER rate to 15 basis points from, say, 10 basis points. The second thing would be raising the RRP, the reverse repo program, raising that rate from 0 to, say, 5 basis points. And what is the reverse repo? That is where market participants like money market funds who don't have access to IOER park excess cash at the Fed in exchange for Treasury collateral. And those volumes have exploded as T-bill supply has dried up. So you can see there back in March, the program was only used on an overnight basis for $11 billion. Most recently, it was almost $250 billion, and even on Monday, I think it hit $390 billion. So those volumes have exploded. So the caveat is the optics of raising rates, even if it's not the rate that is commonly referred to, makes this a very tricky line for the Fed to navigate. So honestly, I don't think they're going to do anything that they don't have to do. So talking about when will short rates rise, and most folks, when they talk about rates rising, short rates rising, they'll be referring to the Fed funds. So we can look to the futures markets and get a feel for what markets are pricing in. So we can see here is the path, the implied rate for the December 2022 contract. And at the beginning of the chart, you can see last summer that the expectations were awfully bearish, that the expectation was that rates were not going to be rising anytime soon. But since then, we've had the steepening of the yield curve, reopening of the economies, the vaccine rollouts, all positive things that have added optimism in a window that a return to normal in the world and in the financial markets may be on the horizon. So that implied rate has been creeping up. So right now we're more or less around 25 basis points. So not fully expecting a full hike. That is more into 2023, but it is trending in that direction. So moving beyond the short-term part of the curve and looking at the impact further out, the Fed's monthly $120 billion purchasing of treasuries and mortgage-backed securities has had an impact on what's happening on the intermediate and the long end of the curve. And while there's been no official word yet from the Fed about when tapering will begin and what the process will be, there has been some public debate occurring between members of the Fed governors discussing whether it's too early to begin to remove support, or the Kansas City Fed president was out yesterday talking about the mortgage market. The MBS market would be a natural place for the first look in terms of peeling back some of that support into the market. So there's a lot of variables when it comes to when the official word comes, what the timeline will be. Will they say something in the third quarter of this year that tapering will begin in the first quarter of next year, or will begin a little bit beyond that? And what will be the pace? Will it be $10 billion a month or $20 billion a month, eventually scaling down from that 120? And the other thing to note is, as the tapering goes away, and then that brings the short end hikes back into play. But if we look back to the coming out of the great financial crisis, the market tends to get ahead of the Fed in terms of what is being priced in and what the expectations were. So those folks who were around in 2010, 2011 and beyond remember that the expectation for the first hike was 2 years out for about the first 5 years of the recovery. So the Fed does move at a slower pace typically than what the market expectations are. So looking at what's happening with rates further out the curve, that this has been a little bit of a glimmer of hope, particularly for depositories, because when you look at the belly of the curve, and this is looking at the change in rates from year end, the belly of the curve, the 5 and 10 year rates, where that are typically more associated with asset pricing, has steepened materially from 50 to 75 basis points, while shorter rates really haven't budged much at all. So when you think about when you open up your doors every morning and a deposit comes in and you look to deploy that in loans or investments, incrementally there's a little bit more spread occurring at every turn. Turning to mortgage rates, it's fascinating. 30-year fixed rate mortgage rates and 10-year treasuries historically, normally, tend to move in tandem. But this past year and a half or so with the pandemic and the refi wave has certainly been a wild ride. And some of those historical correlations haven't typically held. So more specifically in the last 3, 6, 9 months, what we've seen is that mortgage rates have outperformed treasury rates in two different types of market environments. So the first part of that is that as treasury rates were rising, mortgage rates didn't rise as much. So that was that period from last summer up until the spring of this year, where 10-year treasury rates went up by over 100 basis points. Mortgage rates were a fraction of that. The second part has been in the last 2 months or so, where treasuries have stabilized a little bit, but mortgage rates have actually come down a little bit in that period. So ultimately, what does that mean for mortgage spreads? And I think this is the key takeaway here. You look at this chart on the left, and this is looking at the spread of mortgage rates versus 10-year treasuries. And it's been more or less a straight shot down. And it's blasted through the 2019 levels that we have there with the 3 bars, using that as a proxy for normal market conditions. And you can see that we're now at just 133 basis points for mortgage rates over treasuries, which is awfully tight and 100 basis points tighter than where they've been. And if you think about, and if those of you who were seeing some of our articles and webinars that we put out that at the end of in the fall of last year, or had conversations with us, you knew we were adamant about retaining fixed rate mortgages as an opportunity, because the spreads were historically attractive, but also solved some of the excess liquidity and asset sensitivity issues and challenges that were out there. So as we look at the landscape today, and we'll get to it in a little bit, the liquidity and interest rate risk challenges haven't gone away. In fact, they may be amplified, but the spread prospects aren't as attractive as they once were. Similar dynamics in mortgage-backed securities, but as we'll get to a little bit in the third section, the structural differences between MBS and loans, cast those in a little bit of a better light. Now, for a while, I've been in the camp where talking certainly as the interest rate volatility in the first quarter pushed interest rates up high, that the Fed was going to be okay with higher rates as long as it was an orderly process. So to define what orderly means, we want to look to see for signs of systemic stress in different market metrics. So here we're looking at the credit and funding markets. So the TED spread is 3-month LIBOR versus 3-month bills. And that it's all calm there, the very narrow spreads versus the long-term historical averages. Corporate credit spreads, same story, pushing historical lows on BBB corporate bond spreads. Equities are undeterred by any short-term noise and continue to progress towards or through new all-time highs. The one difference where there is the inkling of a possibility of some stress is in looking at interest rate volatility. Now, part of higher volatility comes with, the bond math of our steeper yield curve, so it's expected. But as an old cynical fixed income person, the bond market has a pretty good track record for being the first to sniff out trouble and challenges in the markets. So certainly, looking at the level of volatility and keeping an eye on that is worth watching. All right. So on the economy, inflation talk is all the rage today. So we won't go too deep into that because I'm sure everyone's inundated and they've heard the word transitory plenty of times watching the financial news or reading. But looking at something a little bit closer to home for those involved in the real estate markets is looking at some of the things that are happening in the commodities inputs for housing, and looking at the price of lumber and just astonishing parabolic moves at the end of last year that were erased, but then also again more recently, just in the last month or two, to the multiple of 2x or 3x. So by any definition of the word, that is not a normal move. Sticking with the economic theme and looking at the health of the consumer, personal savings rates are still extraordinarily elevated. Now, part of that is the stimulus that rolled out over the last few months. But and then even looking at things like the Consumer Sentiment Index, we can see while there's been some recovery from the depths of the pandemic, still well below the pre-pandemic baseline. So there's still that measure of cautiousness from the consumer. And then lastly, on the economic side, is the progress of the vaccination, and I think it's great to see here, most especially in New England, that the rollout has been well in advance of what we've seen on the national level. And in fact, if not for Hawaii, all 6 New England states would occupy the top 6 spots for the percentage of people who have received at least one dose of the COVID-19 vaccine. So that is certainly supportive of the recovering economic landscape. So now switching over to what we saw from call reports in the first quarter. So again, unsurprisingly, we'll start with the obvious, and many of the folks on this call will know and recognize that we're running out of adjectives to describe the level of cash that is on many depository balance sheets right now. So to put that in perspective of how high the cash levels are, one of the metrics that we'll look at is what percentage of our members are above 5% or even 10% in cash on hand. So you can see here, if you look to the right of the bar chart, in fourth quarter of 19, the last pre-pandemic quarter, that was just slightly over 10% of banks and credit unions who had more than 10% cash on hand, which is an extraordinarily high number, so it makes sense, only a tenth. In the most recent quarter, those numbers were around 50%, so 1 in 2 members had over 10% cash, so truly an incredible move. And where's that cash coming from? Simply put, there's challenges on the asset side, but first and foremost, it's coming from the inflows of deposits. So what we're looking at here is all of our depository members ranked by asset size, smallest to largest, with banks in blue and credit unions in green. And what we see here is that the median growth in non-maturity deposits quarter over quarter was a little more than 8.5%. So 8.5% is a huge number. And it's even huger when you think about it was 8.5% growth off of an already elevated level that we saw coming out of 2020. So again, running out of adjectives, huge, extraordinary, incredible, you name it. One interesting thing to notice here when you look at this chart is that if you look towards the left-hand side, so our smaller members, you see a lot of the green dots, the smaller credit unions, with above average growth. Alternatively, you look to the right-hand side and you see a lot of those blue dots below the median. Those are some of our larger banks. So I think what we can attribute that to is the impact of the stimulus sent out to the consumer in the first quarter, and in that, relatively speaking, it was our smaller credit unions who saw the above average deposit growth. So we highlighted the growth in non-maturity deposits, and it really hasn't bucked the trend that's occurring in term deposits and the consumer preference for CDs, which really has been declining, going all the way back to 2010, and even in 2015 and 18, when we were in the midst of the hiking cycle. CDs really didn't explode higher. They, at best you could say, they kind of muddled along sideways. So right now for banks and credit unions, it's about 16% in terms of term deposits making up the percentage of total deposits. And I think the longer that we stay in this environment where we're talking about 0% handles on deposit rates, I think we'll continue to see that natural flow from customers to seeking out the optionality and the flexibility of non-maturity deposits. So this is an interesting some data coming from a report that the OCC puts out, their interest rate risk statistics report. When you look at on the left-hand side, so this is the median bank, the OCC bank, and their income simulation. So their 12-month earnings at risk. And when you look at that shape of the curve, many of you folks who come across the ALM process, that looks like an asset-sensitive institution. So the prospect or the boogeyman of rates moving higher isn't necessarily a bad thing, and in fact, it improves the earnings profile of the institution. And one of the main drivers of that is what you see along the right-hand side, is the assumed average lives for some of the non-maturity deposit buckets. And that's before getting into the ability to lag pricing in a rising rate environment. So, your specific mileage will vary in terms of what balance sheet levers you can pull, but and it may seem counterintuitive, but if your profile reflects anything resembling this, then the hedge or the risk reducing move is not necessarily to be accumulating cash, but rather extending asset duration and moving towards a more neutral positioning. And we'll get into a little bit more of that in a bit. Looking at what's going on with loan growth, and these charts may be difficult to see, but these are some of my favorite charts here. And you can see the PDFs after. We'll send it to everybody. But in the top left, just going around the horn, top left is looking at loan growth across all our depositories and looking at it two ways. One, total loan growth, and then the other, removing PPP activity. And when we strip out PPP activity, we can see that quarter over quarter, in fact, loan growth was negative. And it has to be frustrating to those on the call that is the case and that is the condition, especially when you see the historic levels of the inflows of cheap non-maturity deposits, with the challenge in deploying them into the preferred asset class. The top right, and then some of the others is where we take a little more granular look at loan growth activity, broken out by geography across our footprint. So in the top right, it was kind of interesting in terms of looking at 1 to 4 family loan growth. And this is something that reconciles with the anecdotal evidence that we've seen and heard from conversations with members, is that the most growth has been coming from our northern New England members, specifically Vermont, New Hampshire, and Maine. And that's that common theme of out-of-state buyers, moving out of the cities and moving to those locations. And in fact, the softest growth was in Greater Boston and Metro West. The bottom left looks at commercial real estate growth for banks, and again, aligning with the anecdotal evidence. I think pretty consistently our New Hampshire members, and specifically Southern New Hampshire members, have tended to be the most optimistic on not just the building back up of loan pipelines, but actually activity that has been flowing through to first and second quarter loan activity. So that bears out when looking at New Hampshire leading the way on commercial real estate growth. In the bottom right is auto loan growth for credit unions. And the auto portfolios are challenging to grow in normal times because they tend to be short in average life. So the originations really have to be clicking on all cylinders in order to grow. But I think we do see some of the after effects of the pandemic and the work from home environment with the negative loan growth on the auto loan side across the region. So moving to yields and margin, and what's happening with asset yields. It doesn't appear that we've hit a bottom by any stretch. That there continues to be the bleed on investment and loan yields, there's a rather large drop in commercial real estate, non-resi real estate for banks, 21 basis points quarter over quarter, and I think that part of that is refi volume and the strongest borrowers being able to have a little bit of leverage with so much liquidity out there in the markets. Investment portfolios, as to be expected, have repriced faster than the loan portfolios. But at least, a glass half full perspective for credit unions would be that, yields have come down so much where now the median yield for credit union investment portfolios is at 65 basis points. So when you think about potential for margin expansion, you not only have the cash on hand at 10 basis points and being able to invest that, and that adds incremental income, but also the marginal dollar flowing off is very back of the napkin, is coming off at 65 basis points, and in this current environment, that is not a unsurmountable hurdle to clear in terms of reinvesting cash flows into the portfolio. Just mentioning the more to go on the bottom of yields here. You look at non-resi real estate yields for banks at 437. Many members use our 5-year home loan bank rate as the pricing index. 437 would be about advances plus 310 basis points on that yield. And that spread level is way above current market rates from every conversation we've been hearing. So there's more room for contraction there. So looking at deposit pricing, so this is a collection, again, another neat chart, looking at deposit pricing over the last few quarters across all our membership for money market rates with the percentiles, the median, and then the outliers in both directions. And what you can see, unsurprisingly, that the difference between the high payers and the lowest rate offers has contracted pretty significantly over the last few quarters. And one common refrain that we hear from all kinds of conversations is that folks have ratcheted down deposit rates, with the expectation or thought that it may lead to some liquidity outflows. But that generally has not been the case, that rates get cut, deposits stick around. And in fact, as we saw a couple slides ago, deposits continue to come in. So, this is one of the most difficult questions out there right now is how do you balance something that is so hard to quantify and analyze, right? Truly, how sensitive and sticky are my deposits today, 3 months from now, 1 year from now? And how do we set rates to tackle the biggest problem that's staring us in the face right now is all this liquidity with a challenging landscape on the asset side. So we have deposits falling out of the sky, loans are hard to come by. Well, then naturally there must be investment activity through the roof. The short answer is yes. We saw a sea change in the activity patterns for bank and credit union investment portfolios in the last quarter. So what we're looking at here is the quarter-over-quarter growth for investment portfolios broken out by certain bands. And you can see highlighted along the right-hand side, nearly half of all members experienced more than 10% growth in the investment portfolio. And that 50% or 47% compares to between 20 and 30% that we've seen in previous quarters. So investment activity has been exceptional, and we capped that last chart at anything above 10%, and we've seen a lot of numbers where the growth has been 20 or 30%. But putting that together with how phenomenal the deposit growth has been shows us that while investment activity has been robust, it hasn't made much of a dent in the already high levels of cash. So what we're looking at here is where was there more growth, investment plus loans or in deposits? So you can see 81% in the most recent quarter saw deposit growth that was greater than investment and loans. So, I can tell you how many call reports that I've seen where investments may have grown by 20, 25%, which seems like an aggressive bond buying program, but it didn't do anything to pare down the cash levels because deposits almost dollar for dollar matched what the investment activity was. So here's a positive sign and takeaway when thinking about loan credit. And so we went back to the first quarter of last year to the present, and looked at what percentage of members were taking quarterly provisions greater than 25 basis points. And there's that dark gray line. And you can see at the onset of the pandemic, it was about a third of members who were taking those high levels, above average levels of provisions. And that has steadily come down over the last few quarters to where it's just 6% of our members were aggressively provisioning. At the same time, you can see that the two ships passing in the night, the percentage of members in green there who have begun to release some of the reserves that they have previously built up, because thankfully, unfortunately, it doesn't seem that the level of the storm that we thought could occur this time last year is going to come to fruition. So, the release of the reserves is a positive sign. So looking at the performance of public bank stocks, and I've mentioned this before, that even if you're a mutual or a credit union, I think it is instructive and worthwhile to look at how the capital markets are valuing public banks, because it gives you a window into the health and the prospects for the industry. So what we're looking at here is all the public banks. New England, we've constructed an index, and we can see in the green line the price has recovered fantastically, doubling in fact from the lows that we saw in March and April of 2020. And really the two drivers of that has been, like we just talked about, the passing of the potential credit storm, but also the steepening yield curve that makes the potential for spread income and core margin. It's as everybody knows, it's easier to make money with a steep yield curve than a flat yield curve. So, while there's certainly challenges ahead for the industry, I think this is a glass half full sign, because the stock market is nothing else but a forward pricing mechanism. So you'd rather see this level of optimism than the alternative. So, talking about balance sheet strategies, so this is fantastic. We've talked about what's happening in the markets, what's happening on balance sheets, with a little bit of a look in the rearview mirror. But what can we do going forward, right, to position the balance sheets in the best way possible, managing both risk levels, but also return objectives. So I think, I don't think this is going out on a limb too much here, but for many, it's about right sizing the liquidity levels first and foremost. And the asset side is going to take precedence over what's happening on the liability side in terms of the first steps that can be taken. So we'll go through some of these key questions that you can see here, that things that we're seeing, things that we're hearing, and some of the ways you can tackle that. And then also some of the specific and particular funding ideas that once liquidity gets right-sized, then you can zero in a little bit more on the wholesale funding side and take advantage of some of the opportunities there. So, we talked about the high cash levels, and one challenge right now is how much, should we be holding all this cash to prepare for loan demand? So, what is the shape of this return of loan demand? We saw it was negative XPP last quarter, but is it going to come in droves like deposits came, just 10% out of the blue, or is it going to be more of just a resumption of a normal growth slope from here going forward, without the catch up of what has or hasn't happened over the last 12 months? So when you think about the dynamic nature of a depository balance sheet, you're getting cash flow every single day from the amortization and the prepays, both on the loan and the investment side. So I think it's a worthwhile exercise to look at your balance sheet and say, what do we have coming off? And then if we want to get, take our 12% cash and get it back down to 3% over the next 3 quarters, how much do we need to really originate in loans? And is that possible, given that our loans and our investments are throwing off cash every day, that we have to replace that first and foremost, and then we have to originate more to get growth. So, we've run some of these numbers and played around with that, and even building in some deposit stress testing assumptions in terms of potential outflows. And as we saw the first quarter of this year, there were no outflows. It was more deposits coming into the equation. We've seen some examples where you'd have to originate 25% of loans from your asset size just to grow loans by 10%. And that's not necessarily balance sheet growth. That's getting cash pared down from that 12% to 2%. So, in very rare instances, you may be surprised to find that the amount of cash that you have is not necessarily how much cash that you need. So, okay, Greg, we have excess liquidity. Maybe we don't need that much excess liquidity. Well, and our residential originators are continue to be busy, maybe not as busy as they were 8 months ago, but still busy by a normal definition. So should we retain fixed rate mortgages? So in the first section, we talked about comparing the spreads versus treasury. So this is another way that we can look at spreads for how we might think about deploying excess liquidity. So this is the primary secondary spread. So essentially what this does is looks at spreads for mortgage loans, 30-year fixed rate mortgage loans, and spreads for mortgage-backed securities. And so when this spread is at the higher end of the range, there's some relative value in holding loans over bonds. So you can see third, fourth quarter of last year, that spread was awfully high, plus 150, plus 175 at its peak. Now, with that spread tightening in mortgage loans, we've come back now to more of a historical level. So as spreads get narrower, I think the flexibility and the customization and the liquidity of mortgage-backed securities versus the one-size-fits-all of here's a 30-year fixed-rate mortgage that we originate, there may be a little bit more relative value in buying bonds and selling loans versus just holding your residential production. So investments may be the place to be. What should we do? So as we showed a section or two ago, investment activity has been robust, and the average investment portfolio has gone up about 1 or 2% in the last quarter. But what we can see here, so this is a graph of the investment to asset ratio for banks and credit unions going into and out of the last crisis 10, 12 years ago. And we can see at the current levels of 13 and 14% investment to assets, we really aren't near the peak in investment size that we saw last time. Now, I've yet to meet a banker or credit union executive who would rather have a 25% investment to asset ratio than a 10% investment portfolio. But we are in atypical times, and I think that the nature of the composition of balance sheets as well as the opportunities in the markets, present these opportunities where you have to deal with the market conditions that we face. So there's a number of strategies, as I mentioned before. If you're asset sensitive, that steeper yield curve is actually a risk mitigating move. So going out to that 5-year part of the curve in any number of structures, whether it's mortgage-backed securities or agency bonds, there's some more opportunity and value there than maybe there was a couple months ago. And again, the flexibility with shorter securities, whether it's 10 or 15-year mortgage-backed securities, that if you are sensitive to duration risk or not having cash flow, then those are options at the expense of giving up some of the yield, but still incremental yield versus what you're earning in cash, that are going to put you in a better position maybe than you are in today. So there was the asset side. I said the liability side is less of a focus, but there still are some levers to be pulled in terms of deposit pricing. So here, this little two noisy charts here is looking at cash to assets for banks and for credit unions, and then some deposit metrics. So first on the left here is for credit unions, cash to assets on the x-axis, and the y-axis is the money market rate. So you can see it's kind of all over the map in terms of folks who are with high cash and thinner cash and high pricing and low pricing. So I think the opportunity for margin and liquidity relief rests in that upper right-hand corner. So if you have a 17% cash, but you're still paying 40 basis points on your money market rates, I think that's a low-hanging fruit. Now, obviously, there's more variables that go into why you price deposits where you do than just the quantitative side of things. But as you balance the margin and earnings needs with those things, those folks who are with high cash, with high rates, can certainly test the elasticity of your deposit portfolio and hopefully get some margin and liquidity relief at the same time. On the right-hand side, it's for banks looking at cash to assets, but also those folks who have higher CDs as a percentage of their total deposits. And as we mentioned, it was about 16% was the median bank, but there's still a fair number of banks out there with 20, 30, sometimes higher allocation towards CDs. So as those are coming due, there really is the opportunity to reprice the deposit portfolio and maybe trim some of that cash as well. So great, you work through the asset, you work through the loans, you work through investments, you work through the deposit portfolio, and you get your liquidity back into a more normalized place. So there's a couple of things on the wholesale funding, the advanced side, that I think are worth pointing out that can be attractive and useful. So the first thing would be looking at the inverted front end of the curve. So as many are familiar, that 12-month part of the curve is typically the lowest rate, but also the tightest spread to treasuries of advances. And recently there's been the 1 year has been in the Tuesday, Thursday markdowns, along with the 1, 2, 3, and 6 month maturities. But another thing here is that the 1 year is eligible for the advanced renewal discount program, which is a way to save 2 to 4 basis points versus the posted rate. And you don't necessarily need a renewing advance to take advantage of that program. So, feel free to call the member funding desk, and they can walk you through that process. Secondly, would be our discounted housing advances. So as many of you know, the mission of the Federal Home Loan Bank of Boston is to support affordable housing efforts here in New England. So one of the ways that we do that is by offering community development advances that are discounted versus the classic rates. So here you can see discounts of between 10 and 28 basis points from 1 to 5 years. So each member gets up to 35 million of CDA and 15 million of CDA extra funding per year. So reach out to if you're not familiar with this program or the application process, pretty straightforward. Reach out to your relationship manager, and they'd be happy to walk you through what you would need to do to get that in place to be able to access that discounted funding. Then lastly, one thing that has been of particular interest of late has been forward starting advances. So, one common refrain that we've heard from a lot of folks, and as we've seen through this presentation, is that with all the excess liquidity, funding, incremental and new funding isn't necessarily something that many folks are seeking out right now. But the level of rates right now and spreads is attractive. So how do you reconcile those two? So forward starting advances are a way to tackle tomorrow's funding needs, but with a price that is determined off of today's yield curve. So here's an example of an offering that we had last week, and many of you may have seen the daily rate emails where we've had some special offerings. So this was an example where it was an 18-month advance being offered. But rather than being disbursed immediately, there was a 6-month delay. So the rate of 44 basis points, you don't have to pay. You don't have to purchase any activity stock or have collateral tied up against it until it gets dispersed 6 months out. So this can be a useful tool to guard against any potential deposit outflows that you may be modeling or expecting in any extraordinary loan growth that you may see coming down the pike, or even hedging against rates rising. If your asset sensitivity isn't like some of the examples we worked before, there would be a benefit there. And like many of our advances and solutions, there's an infinite number of ways to customize them. So while you may see the one offering out there, if you want to move around more to your unique needs, the delay for the disbursement or the final maturity, I think we have a series of offerings going out tomorrow, 7-month and 15-month, 7-month delay, 15-month maturity, and then 8-month and then 18-month. Don't quote me on those. But again, we can customize those in a number of different ways. So with that, that wraps things up. Thank you everyone for your time here. If there's anything that you saw here that you would like to dig in or discuss, or if there's any of the reports or pieces related to the peer analytics, we're happy to put together a report or series of reports that you can pass around in ALCO or management committee, things like that. Reach out to your relationship manager or us directly, and we'd be happy to help. That's what we're here for. So thank you everyone for your time today, and hope you have a great rest of your day.